Gold. The word carries weight. For millennia it has crowned kings, triggered stampedes and launched ships across oceans. But does it actually make sense today for individual investors such as yourself? Buckle up. Serious research on this subject is as rich and dramatic as the metal itself. Let's start with a brief financial history of gold from ancient times until Bretton Woods. In ancient times, gold was a store of value. In circa 550 BC, King Croesus of Lydia in Western Asia oversaw the creation of a technology to separate gold from silver. The world's first pure gold and pure silver coins appeared. Croesus thus created the bimetallic system, which revolutionized international trade. Unhinged paper money printing led to hyperinflation in France in 1795, as seen here earlier. Could gold be used as a tool to anchor the value of paper money, avoiding inflation? This was the gold standard, a system where a country's currency has a value directly linked to gold. The first country to adopt the gold standard was Great Britain in 1816. Financial stability and wealth followed, paving the way for the Industrial Revolution. Other countries then copied this financial innovation. After World War II, the Bretton Woods Agreement was signed in 1944. At its core was the US dollar gold standard, a fixed exchange rate regime in which the US dollar was pegged to gold at a fixed price of $35 per ounce, and all other participating currencies were pegged to the dollar. This allowed for predictable international trade while providing more flexibility than the rigid pre-war gold standard, as countries could adjust their exchange rates to deal with fundamental disequilibria. The end started with the Nixon shock on August 15, 1971. The U.S. faced a run on the bank as other nations demanded gold in exchange for their surplus dollars, as specified by Bretton Woods. But Nixon unilaterally suspended the convertibility of the U.S. dollar into gold, effectively reneging Bretton Woods. The result? As Nixon's catastrophic policies led to the 1973 oil shock as seen here earlier, inflation exploded, and so did the value of gold. This was the famous gold bull run of the 1970s. For the remainder of the 1970s, inflation and gold prices exploded in lockstep. The inflation beast, unleashed by Nixon, was not defeated in the Carter years, despite several interest rate hikes. It would take Paul Volcker to kill inflation starting in 1979. Did the great gold bull run of the 1970s continue in the 1980s? It did not. Whereas gold exploded in the 1970s, it then crashed throughout the 1980s, a decade in which inflation receded worldwide. Inflation and gold prices, which one causes the other? The relationship between inflation and gold was studied by several scholars. Let's start with Joseph Hobrich. In 1998, Joseph Hobrich at the Federal Reserve Bank of Cleveland noted that gold had just dropped below its lowest price in 20 years. Back then, and also today, some financial analysts will tell you with a straight face that gold is a store of value, and thus a conservative investment. Really? If you bought gold in late 1980, it would take you decades to recover your investment. What kind of store of value is this? And today, gold is in a massive bull run. Will this bull run last? We'll see. Back to Hobrich, he asked a hard-nosed question. What does gold's price actually tell us? The answer is that gold seems to work as a leading economic indicator, sometimes predicting inflation spikes. What actually makes gold prices move? A landmark study by Shubhasis, they examined 30 major economic events, from the suspension of the dollar's gold convertibility in 1971 to the end of U.S. quantitative easing in 2014. He found that the U.S. economy and the dollar monetary system are the main drivers of gold prices. More recent research by Schreider and friends concur. The U.S. dollar is the dominant variable influencing gold prices, and this finding held remarkably stable across decades. But is gold a hedge for you? Here is where it gets interesting. In one of the most cited papers in finance, Bohr and Lucy pose a simple question. Is gold a hedge or a safe haven? They define safe haven as assets that are uncorrelated with stocks and market crashes. A hedge simply shows no correlation on average. The verdict? From 1979 to 2009, they find that gold is both a hedge and a safe haven for major European stock markets, and the US, but not for Australia, Canada, Japan, and large, emerging markets. And even in countries where gold seems to work, there's a crucial catch. Gold functions as a safe haven for only around 15 trading days following an extreme shock. Investors who hold gold beyond that window tend to lose money, suggesting that the smart play is to buy during turmoil and sell as confidence returns. Let's go back to this inconvenient chart on gold prices. If you bought gold in late 1980 and held for at least 1 month, did you buy a hedge or a safe haven? Neither, obviously. So much for taking gold as a defensive move. If you are considering going into gold today, how do you know you are not buying the very top, just like those poor suckers in 1980? Relatedly, Erb and Harvey challenge the popular belief that gold protects against inflation for the average investor. They show that while gold maintains its purchasing power over centuries, it is a very unreliable inflation hedge over typical individual investment horizons over 10 to 20 years. Given all of the above, should you own gold? Investors tend to buy gold to protect wealth during economic uncertainty. In prosperity, however, most buyers abandon gold in favor of other assets. Next, remember that gold is a zero-yield asset. It generates no income, unlike stocks that pay dividends, bonds that pay coupons, and real estate that pays rent. Finally, gold returns are very lumpy. Depending on when you buy gold, it will not keep pace with inflation for a very, very long time. Gold is not magical, neither a guaranteed inflation shield nor a crisis bunker. But academic evidence shows that it could play a role in protecting portfolios in high-stress moments. In short, gold is not for individual investors, but could be a tool for professional traders with the quantitative skills to pick those magical 15 days, when gold will truly shine, the nerves of steel to enter and exit as planned, and frankly the luck one needs in shorter time frames. In sum, caveat emptor. Our verified sources are here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community, striving to learn from the misfortunes of others to avoid similar fates.